U.S. tariff refund expectations are creating a rosier outlook for the big automakers, but with companies like Ford warning about the potential negative impact of the Middle East conflict, should investors be buckling up for a bumpy ride ahead? Joining us now to discuss is Itay Michaeli, Senior Analyst for Autos and Auto Parts with TD Cowen. And for full disclosure on the companies covered by TD Cowen, please see the link at the end of this video. Great to see you again, Itay. Let's talk about some of what we're getting out of the reports this week. What's the flavor? What's the big takeaway?
Sure. Well, first, thank you for having me. It's been an interesting earnings season thus far. You're right. It's been sort of this push and pull between the benefits of IEEPA credits that the automakers have been accruing. That's been some upside to the quarter and the full year outlooks. And that's been largely offset, or at least partially offset, by higher commodity costs just tied to the situation in the Middle East. I wouldn't say the commodity costs are, of course, any surprise. I think we've all been kind of bracing for the automakers to update us on what these headwinds will be. And depending on the company, some companies have been able to sort of kind of hold the guide. Like the GM, for example, where they were able to maintain their full year earnings guidance outside of the IEEPA credit. Whereas for some of the others, IEEPA has been partially offset by some of these headwinds to yield sort of an upward guidance raise, but not by the full amount of the IEEPA credit. So I would say no major surprises. And the Q1 results were actually pretty good. So no negative surprises there, but some puts and takes, as you pointed out, too, in the outlooks.
So when an American's in their car, they drive past the gas station, they see the price. Obviously, we've hit highs that we haven't seen so far in this conflict. We also know that consumer sentiment has been poor in the States. You start putting those things together, and we look forward for the auto industry. Do we have concerns about demand for new cars, even used cars?
Absolutely, and you hit it. This is now the big focus area, right? We have some clarity on costs, commodities, IEEPA, but the main focus has been and remains what's going to happen to demand in light of the geopolitical macro situation, and of course, you pointed out higher gas prices. So far, so good. March was a pretty strong month for U.S. auto demand, and even full-size truck segments were pretty strong. Indications, we don't have April numbers yet, of course, but indications we've written about suggest that it should be another pretty good month. So kind of 2 months into it, roughly, so far the data points have looked pretty good. And really, we think it's for two reasons. One, we've written a lot in our research about significant pent-up demand that still exists in the U.S. This is mainly through some of the survey work that we've done and other proprietary work, and also just underlying structural strength in the all-important full-size pickup truck market, the full-size pickup truck market being a major profit center for the Detroit 3 automakers. So that structural growth and the pent-up demand so far have been able to overcome some of the recent macro noise, but we have to pay a lot of attention to it going forward. Back in late 2007, we did see when oil prices went up pretty readily, almost within a month or two, almost immediate pressure on U.S. auto demand and truck demand as well. So far we haven't seen that, but as you noted, this is now the key focal area in the coming months.
The automakers have largely, and even on a global basis, been pulling back dramatically from their electric vehicle plans over the past couple of years, taking multi-billion-dollar write-downs. Now you got the price of gasoline soaring. Maybe some consumers are starting to think twice. How is the industry positioned right now? Are they any more favorable towards EVs? Is the consumer getting more interested in EVs?
Absolutely. We actually published about a month and a half ago a large report calling for the looming bottom in U.S. EV sentiment. We do think demand and sentiment alike will be on a recovery path over the next 12 to 18 months. As you pointed out, yes, there has been a lot of write-downs for some of the decisions that were made years ago, product decisions, investment capacity decisions. But underneath it all, there's still a lot of innovation within electric vehicles, both on performance, range, and cost. And there is still a pretty healthy new product cycle that's coming in the next 12 to 18 months that we think should help drive demand. The other factor here we've written about is we think the U.S. is actually structurally set up very, very well. Even though the U.S. is lagging the world in EV penetration, it has some structural benefits in the sense that we have 2 vehicles per household on average in the U.S., the highest of kind of any major economy in the world. And so the burden to adopt EVs is actually a lot lower because all you kind of need is more households to kind of decide that having one, let's say, ICE or hybrid vehicle and one EV is sort of the best of both worlds, to enjoy kind of the best of both of the technologies can provide. And if that were to happen, particularly as new products begin to roll out that are more performant and lower price, we think there's scope for EV sales to potentially inflect fairly sharply over the coming years. And to your question, we have seen a little bit of some initial signs of stability in U.S. EV demand. I'll quote two data points. First, in March, if you look at the companies who actually report monthly EV sales, not everybody does, but a fair amount do, the penetration of EVs for these so-called reporting vehicles was the highest in the U.S. since IRA credits expired. So that's pretty encouraging. And the second data point is if you look at the EV sales relative to inventory levels, right? Because inventories come down a lot of electric vehicles over the past year. The sort of sales to inventory ratio, just measuring what percentage of available inventory was effectively sold in the month, that ratio was flat on a year-over-year basis, right? And last year, of course, there were still credits available. So some early signs, we'll have to keep an eye on it going forward.
All right, great report. Something for our audience to check out after we've had our conversation. We talked about the IEEPA refunds, and that's helping the automakers in the here and now. I think about the negotiations going forward for USMCA from your side of the border, from CUSMA on my side of the border, how integrated a lot of the supply chains are for auto parts between Canada and the United States. Do we need to keep our eyes on that going forward in terms of tariff pressure costs?
Yeah, absolutely. I think at this point, we have some clarity on what the current impacts are to tariffs, but to your point, we have to pay very close attention to USMCA. We've asked all the companies this. They're not saying a whole lot right now. I think there's some cautious optimism that something could get worked out later in the year. But we'll kind of have to wait and see in the coming months to kind of see where that goes from here.
All right, so we got a lot going on in the space. We put it all together. What names are looking interesting in this environment?
Yeah, there are a lot of interesting themes. I think kind of cyclically, we talked about the U.S. demand resilience, what's happening with pickup trucks. That's very relevant for the automakers specifically. EVs, as we talked about, another really interesting theme as well, which affects not only some of the EV companies, whether it's Tesla or others, or Rivian, but of course also some of the suppliers that sell into EVs. And underneath it all, there's still a lot of momentum here in vehicle autonomy, whether it's robo-taxis or personal autonomy. We will start to see more and more vehicles equipped with next generation technology in the coming years. So keeping an eye, of course, in some of those companies, whether it be Tesla, Rivian, Lucid, and some of the suppliers. We do expect a lot of activity in that space going forward.